a tough act to follow Joe. But I'm feeling pretty good up here about this panel that's going to bring it home tonight at the day in the summit. Like to say we maybe save some of the best for last. So quick introduction of myself, and then I'll pass the mic over, so to speak, to these guys. My name's Anna Tharrington. I'm one of the managing partners at Hutchison. For those of you that don't know us, we hope we get to know you. But we are a venture boutique law firm, which sounds a little funny, but what we do on a daily basis is we work with what we call growth stage companies. So businesses like a lot of yours, as they go through the life cycle of formation to funding to exit. That's been the bread and butter of our firm for 30 years now. So we've got a big birthday next year as well. And over those 30 years, we've stayed kind of true to that thesis. And now we have what we call an investor side practice. And so that brings us into the world of folks like the ones beside me and getting to engage and work with those investors that help write checks into our company side clients so that they can grow and scale and exit. So without further ado, I'm going to ask each of these folks beside me to introduce themselves, maybe tell you a little bit about their organization and what gap or need it was designed to fix. After that, we'll do a little bit of Q&A up here, and then we'll leave some time for you guys to ask your questions as well. Pass it over to Jeffrey first.
Hi, good afternoon. Thanks for sticking around. My name is Jeffrey Kaplan. Today I'm talking about venture, Asheville and Optimist Ventures. But before I do that, I want to talk about the F word I'm bringing to the stage. For the past 2 days, I've been harping on about the decline in new venture creation rates across our state, specifically in the Asheville area. And I think part of that's because of immigration. Immigrants in this country start ventures at 2.5 times the rates of native-born citizens. Immigrants in our country, like my family that came from Cuba when our family's business was nationalized by the Republic of whatever, Cuba, Castro took it away. Our family, these Cuban Jews, ended up in Charlotte, and they thrived. My grandfather founded the Latin Community Center in 1969. There's an article about it in the Charlotte Observer. If you pull up the old files, you can find it. And our family's business was Highland Mills, creating hosiery, pantyhose, socks, underwear. And you've probably, if you live in Charlotte, you know that as Optimist Hall. That's our family's old factory. And we're really proud of that story. But I want to share a message here to this room. The importance of immigrants to entrepreneurship. If you are not supporting immigrants in your communities, then you don't give a fuck about entrepreneurship. And yeah, Asheville's awesome. We're on the rebound from the hurricane. We want you to come visit. We have some really exciting things happening. The gap in the market we are addressing. We started reverse engineering the funding problem in our region about how do we moneyball a fund. Can you get a positive return to investors by looking for averages, singles and doubles, instead of hoping that 1 in 10 is a unicorn? And I'm excited to talk more about that shortly.
All right, next we'll go over to Scott.
This will be more G-rated. Jim's mic always works. But he doesn't need one. It's ironic. So I'm Scott Wingo. I'm a serial entrepreneur in the Triangle area, working on company number 5. About 10 years ago, I felt like we had a pipeline problem, meaning I'm not a salesperson, but we had leads and closed. So we knew we had lots of startups, and we knew like Pendo and all these other companies were going to be big successes, but we didn't know what was in the middle. So I thought I could help define that middle. I used this term triangle tweener to kind of talk about that middle layer. I had a tweener daughter at the time that was 12, and they're hilarious. They think they're 30 years old, and then they like run into a wall or something or eat a crayon or a Tide Pod. Don't do that. I thought that's kind of how these startups are. You know, I'd meet these founders like, yeah, I got to $1 million, and now I'm ready to expand internationally. And I was like, well, yeah, I like your energy, but let's wind that back a little bit and get there when you get to 10 million. So started this list, and then really liked the dynamics of that list. And I thought, why hasn't anyone done what you see in the public markets, where there's people that pick winners like Fidelity and these types of money managers. But then you could just buy an index. Like, why can't we just buy an index of the Triangle's best startups? So I thought that would be a really nice differentiated thing to put in the market, and started a fund called the Triangle Tweener Fund about 3 years ago. And now we've invested over about $11 million in Triangle only startups. Minimum, our average check size is about 50K, and we're in 165 companies, if you can believe that or not. The Triangle has 320 tweeners, so that's how big our ecosystem is. And I like that measurement because it kind of is, it's harder to track the really early stage folks because there's so much going in and out of business. But at this point, they're relatively stable, and it's a really good measure of how the ecosystem's going. We'll talk more about that. Over to you, Jim.
Hello, my name is Jim Roberts, and I've been the punching bag in this conference for 2 days. I earned it. I've been punching for 20 years. The last 2 days have been my day. I'm really proud to be sitting next to Scott. He's really my hero in all of this, just doing amazing things. He came and spoke at my investor buzz-in and gave really a 90-minute MBA class on his career, and then 45 minutes on 12 insights on how to scale a startup. If you'd like that video, I'm happy to send it to you. And again, I'm thankful to Scott.
Go speak at Jim's events, because there's a 30-minute free beer before you talk. My jokes were slang. Like, people were laughing at stuff no one else has ever laughed at. It was great.
Well, again, he was making fun of me, which everyone enjoyed. I assume I'm on the last panel because I thought I was the most likely to drop an F-bomb, but my Florida Gator alumnus next to me dropped it first. So again, I'm Jim Roberts. I am the founder of the Network for Entrepreneurs in Wilmington and the WALE Angel Network. If I look familiar, it's because I've been in this room for 25 years. I started the first entrepreneur organization in the city, tech startup organization in the city of Charlotte in the year 2000. I started the first tech entrepreneur organization in the city of Asheville. I worked for the NC Biotech Center in their COIN, the Center of Innovation for Nanobio. I worked for the North Carolina Department of Commerce and International Trade, and then got recruited to Wilmington to open the UNCW CIE incubator, where within 12 months of opening, we were named one of the top 50 incubators in the country with a very nice $100,000 check given at the White House. That was the Obama White House. In 2015, I started my own 2 organizations, New and WALE. And the reason we started, because we needed our entrepreneurs to have local money to be able to travel to bigger cities and say, yes, we were supported in our hometown, and they could call me and say, why did you invest in that company? It is a major red flag if your startups aren't raising money in your city, because when they travel, that's the first question. Why didn't anyone invest in your hometown? And the second question is, well, if no one invests there, why don't you come to our town? I don't know if you know this right now, but the city of Atlanta is building the largest startup village in the world right now. One guy bought 56 buildings to create a startup village in downtown Atlanta. And he can't wait to steal our startups. His name is David Cummings, by the way. He writes the best content on LinkedIn. I suggest you read it. Thank you.
Hi, I'm Stan Parker, President of Winston Starts and a general partner in the Whisper Fund. The Whisper Fund was started about 4 years ago, Jim, as a result of not having local capital. We surveyed our founders and every year, and we asked them, what do you need and how are we doing, and what do you think they said they needed most? Capital. And so Whisper was started to help provide local capital. We've been at it we're in our 4th year. The way the fund works, myself and 2 other people are general partners. This fund works, the general partners bring companies to the membership. There's about 80 members, and the members decide individually if they want to invest. And if we get, we have a hurdle rate of about $100,000. If we hit that as a minimum, we'll do the due diligence and cut a check, and it can go pretty quickly. It can go 5-6 weeks and do that. In the last 3+ years, we've made 21 investments in 13 companies. $4.1 million invested. 3 of those companies, Tom, are NC Idea companies, including STEMS, which you guys saw earlier today. That's a little bit about us.
Awesome. Thank you, guys. What we are not going to do next is pick on Jim. So instead, we're going to start with Scott. So, Scott, in our world, from the companies we work with, it is almost impossible not to have these early stage companies come in and think about the Tweener list or the Tweener fund. And it seems to me that you guys have to be pretty popular. Can you maybe share a little bit more specifically about the types of companies that you're writing checks into in terms of operator team size, revenue size, and then also how you're managing just the sheer volume of the region that you guys are serving, being right here in RTP?
Yeah, so we don't do biotech. So anything that requires FDA approval is kind of outside of our wheelhouse. So that's one way we kind of, that cuts off a big section of innovation in the triangle, but we just don't have the scientist in it. It's a different startup. They typically go 5 or 10 years, then they get this binary, did you get FDA approval or not? And then they typically have to go another big chunk of time. And so it's a much different capital structure. So we don't really mess with that. We've got Hatteras and all the other folks that do that. So they're usually high tech. We don't do service they have to have some intellectual property. And like Joe said, we love to see, like an engineer on the team, someone that's kind of coding. We earlier stage. So the Tweener mark is $1 million in annual run rate, which is like $80K a month, which seems pretty low, but it's kind of hard to get there, right, Jim?
Yes.
Yep. Yeah. Jim agrees. And once you get to that, what the data shows in my little Tweener list is once a company gets to that level, they're pretty sustained around here because it's a lot cheaper to hire people in North Carolina. And if you hit some speed bump, maybe you have to cut staff or don't hire someone, but you can kind of get there from $80K a month. So that's one of the bars that we look for. So that's another one. So no biotech, and we want you to be at that level. So typically to get to that level, the team needs 5 to 10 people is another piece that you look for. And they do typically have a tech kind of an element to it. In the last year, it's been mostly AI companies, as you can imagine. But these aren't like the open AIs, these really horizontal things. They typically are very vertical. So they're doing AI to solve a government problem, like Chip's company over there. I don't know if Robo's here, but we've got 2 gov tech companies in the AI space. We've got a ton. Our biggest segment is health tech, which is different. It doesn't require FDA approval, and it's usually software and some underlying technology to improve the healthcare system and outcomes. So it's a lot of electronic health records. We're in Keebler Health, which is another AI company that does the coding for people, so they don't have to do all this coding of different processes, faster insurance claims, all this kind of stuff. So that's kind of the profile, and then it's all over the triangle. So you find stuff, it usually is concentrated in Raleigh-Durham. You see some Chapel Hill kind of around the university there. Then you have a smattering of things out to just all over the place. Rollsville and Holly Springs. A lot of people live in Holly Springs now, so they're like doing things all over the triangle. So what's nice is because we are in a tighter geography than the whole state, we can meet everybody, and usually lots of coffee meetings. I like coffee, thank God, because I could do a lot of coffee meetings. I probably had coffee meetings with half the people in this room. So that's kind of did I answer all your questions?
That was perfect.
Okay, all right.
We've got one more for you. The fund itself. Can you tell us a little bit about, for those that are getting to know the Tweener Fund, how do you guys pull investments from sort of the capital perspective? How many folks are writing checks? Are they large sizes?
Yeah, so when I started thinking about this, everyone said the hardest part, finding companies that want money, is relatively easy, right? So as Tom and team can, all you have to do is hang up a shingle and suddenly there's a line of people. So that part's easy. And I kind of view it as a 2-sided marketplace. I come from e-commerce, and if you think about like eBay or Amazon, there's like 2 sides to this marketplace: buyers and sellers. In this example, we've got startups and founders. That's the easy side of this marketplace. The hard side is the capital. And what I found was we have 3 bigger funds in the triangle: Bull City, Idea Fund, and Co-Founder. So there's others, but those are the big 3. And they've grown up to be like $80 million funds, which is great. But the unintended consequence of that is if you want to be an LP, it's a $300,000 commitment, it's spread over 5 years, which makes it less of a big size check you write initially. But I had folks at my company, Channel Advisor, that we took public, and they made $1 million or $2 million for that. and they want to be involved in the startup community, but they can't really find a place. And they don't want to do angel investing where they like have to go to all these meetings and do their own due diligence and stuff. So they usually have jobs as well. So they don't have this. They're not like in the retired phase, which a lot of the angel communities have more folks doing that. And so we needed a place where there's a lot of people I detected that wanted to invest like $30K a year, a smaller check. And then, that's our commitment is $30K, and that's it for 1 year. And then a lot of people continue on after that. And it's also, if you ever do a venture capital fund, they have this evil thing called capital calls, where you sign up and they say it's going to be on this pattern, and then suddenly like so many great companies came in, we're going to call 30% of your capital. And you're like, but my kid just went to college and I signed a mortgage. And they're like, well, don't care, you owe it. So that one's like, it makes it very hard as an LP, an investor, to plan for your cash outflows because of that. And the way our fund works is they're on the quarter. So you take that $30,000 a year and it's $7,500 a quarter, very linear. And we use this infrastructure. The way we're able to do so much, we do 15 investments a quarter. Bull City will do that in their whole fund's life. And the reason we do that is we have an automated back office. So we just literally go through a form and submit investments, and a team of lawyers in California vet all the legal docs, which is good. The legal docs have gotten simpler with the advent of the SAFE mechanism, which is the most prevalent. You know this, but why am I telling a lawyer that? But a SAFE document is the most prevalent way of doing this, which is like a 2 or 3 page document, which is an innovation out of California again through Y Combinator. And then lastly, and this makes a lot of other investors kind of throw up a little bit, is we don't really do due diligence. So we do look the entrepreneur in the eye, and we basically see that it's real. We see a demo, but we don't go through their bank accounts. We don't talk to 100 customers, because our theory is, if people paying you $80K a month, companies or even consumers, that's the due diligence. That customer did their due diligence, and they wouldn't have written you a check if you were defrauding them. Now, we have said no to some people because the tech wasn't real. It was kind of like didn't really pass a sniff test. But we don't go through and then being on the receiving side of due diligence, you always go through this exercise that's called a TAM analysis. And every VC that's ever said no to my TAM was like ridiculously low on the TAM, and I blew it away. So I have as being a founder, I have a fundamental disagreement of how you calculate TAM. And everyone didn't invest in Uber because the TAM was like 2% of taxis. Well, that was wrong. So on and so forth. So that's why we go so fast, is we don't get caught up in a lot of that process stuff and what that means for the founder is, it's like, okay, do you meet our requirements? Yes. We want to write you a check. Let's do a couple quick checks. Okay, you're through those. And it's usually like in 4 or 5 days we can write a check. So that's how fast our process is. So it's like, because we have to go chew through this very quickly, we do it very quickly.
Gotcha.
And that's why he's my hero.
Awesome. All right, we're going to go down to Stan next. So, Winston-Salem, for those that maybe don't spend as much time there or aren't as familiar with the entrepreneurial ecosystem in Winston-Salem, can you give us maybe a zoomed out view of what's going on there, co-working spaces, how it's sort of bubbling up?
Sure. I'll go back just a little bit. At one time, Winston-Salem was a hotbed for entrepreneurs. We completely lost it.
Mr. Reynolds, I believe, is the top of that list.
Haynes, Wachovia, Piedmont Airlines, Garner Foods, Texas, and we lost it. And I can go about 10 years ago, some folks decided, how do we get that back? And today, we're not there, but we've made progress. There's 43 ESOs in the city trying to help founders. Most of those are focused on Main Street. There's a few on scaling companies like Winston Starts, Innovation Quarter, partnering a lot with a lot of different factions at Wake Forest to help folks out, providing a wide range of services, space. Winston Starts has 35,000 square feet of great workspace. There's mentors, there's coaching, there's helping people get ready to raise money, making connections with people so they can do it. I'm closer to Winston Starts. Just in the last 7 years, we've helped 107 companies. These companies have raised $145 million. In the last 12 months, we have 40 in residence now. They generated about $30 million in revenue and created about 300 jobs. But there's a lot of other folks doing great work in town too.
Yeah, that's fantastic. Definitely a place to pay attention to. And when we first talked, you shared a great story about one of Whisper's investments, and I was hoping maybe you could share with the group. I think it synthesizes really well how the funding model is working. You mind sharing that with the group?
Yes, it's a great, I love to tell this story. Of our 13 investments, they're like children, right? You love them all the same, but they're not all the same. And this story, we had a group of 3 young guys. They were 22 years old. They had 23 years old. They just finished, they were both undergrad and masters of mechanical engineering students at NC State. As part of one of them's, they had a course where they had to create a product, right? And one of them had done an internship with a commercial construction company. And he noticed on site, materials would come in and some of them just didn't fit. Say it's like a steel beam. And that's, you know, there's a couple things you can do. You can find a welder if you can on site to, you know, make a cut and make sure it fits. Or worst case, you have to send that beam somewhere and everything kind of stops. So he comes back to his other 2 buddies and says, what if we build this, we build a product, it's gonna be a robot arm. We'll have attachments, different attachments depending on what you're trying to cut. We'll write some proprietary software to tell it what to do, put it on an iPad, and there you go. So I think they got an A on the project. Someone said, I think you've got something here. So first time we met, one of them was one of them had was a fiance, 3rd-year law student at Wake Forest, and we meet him at a place, a makerspace place, and he comes walking up with a little case. He opens it up, he sets it up in 5 minutes, and makes this just precision cut on a steel beam. And we had brought a construction guy with us because we didn't know anything about construction. So we turned to the guy and said, what do you think? He says, well, how much is this thing going to cost? And he's like, you know, remember he's 23. He goes, I don't know, maybe like $7,500. And the guy starts laughing and says, $7,500, that'll break even in less than a month on an average construction site. So you're in. So first thing they want to do is they come to Whisper and they want to raise money. They want to raise $500,000. And we said, no, first thing you got to do is get a customer. And so we said, go get some customers. So they go out and have 10 sales calls and they make 9 sales. So they come back to Whisper and they do their pitch, and we've been averaging checks of about $140,000. They got $415,000. Today, they're charging almost $20,000 for the same product, and they're probably never going to raise money again. So we need more of those.
100%. All right, going to turn over here to Jeffrey. So you were telling us about Optimist Ventures. We obviously all aware of sort of Helene and coming out of the hurricane. Can you talk to us a little bit about what kinds of companies that you guys are helping and maybe what the difference is from like what we heard from Scott?
So Asheville always has to do things differently, and we look at funding the same way. So when I moved to Asheville 9 years ago, and the talk in the town was, we're going to be the next Austin, we're going to be the next Boulder, and I think that's misplaced. You ask those folks, they want to be the next RTP. You ask those folks, what do you want to be? They want to be the next Boston. You ask Boston, they want to be the next Bay Area. You ask the Bay Area, what do you really want to be? And it's the next religion, you know? So really wanted to start thinking deeply about like what really fosters itself and grows well here in Asheville, and how can we further the natural trajectory of our ecosystem instead of shoehorning us into a playbook that might work in Austin or Boulder. Well, what are our resources and how can we leverage them here well? And Venture Asheville turns 11 years old, and you look at some of our most successful companies. You know, we got Ben Colvin with Devil's Foot over there. We got some great up-and-comers, Marla Amplification, Full Moon Tea, Shuttlebee. Like, these companies can thrive and do super, super well in Asheville. You know, I don't know if Devil's Foot would be as big or as supported had it started in Greensboro. You know, it didn't have the same brewing community. It didn't have the same, you know, natural support of the fanaticism to buy local. And I was watching a TikTok one day from a VC. I was like, here's what happens to 90% of our portfolio. They show up with $1 billion TAM. They raise some money from us, and then yada, yada, yada. They end up maturing into really good tech-enabled lifestyle businesses, and the investors get burned, and some of those companies do well and some don't. And I started realizing that we've built the entire Asheville ecosystem off of the values of venture capital, that we should do economic development in the way of you make 10 investments, expect 8 to fail, 1 might do okay, and 1's gonna be a big win. And if you're a VC, the multiple on the returns, fine. You and your LPs are gonna do great. But as an economic and community developer, if I'm hitting 1 in 10, I'm doing a real shitty job. So that started us thinking, how do we work backwards? How can we foster the most tech-enabled lifestyle ventures that support our companies as well as giving our investors, our LPs, a fair return? And to make it more complicated, we're a nonprofit. So it took us about a year to figure out this structure. We got a grant from the Dogwood Health Trust. It allowed us to hire my dear friend and colleague, my work bro, Matt Godfrey over there, and funded us for 2 years and our operations for 2 years to figure out how to do this. And so I want to give some of the architecture behind how Optimist Ventures works. So under the nonprofit we have, which is called the Community Betterment Foundation for Western North Carolina, there is a for-profit C Corp called Optimist Ventures, Inc. Optimist Ventures, Inc. has an LLC. All right, so it's this Russian nesting doll of sorts of
We're familiar with
entities.
complicated structures.
Yeah, right? So we raised $500,000 from donations from philanthropies, Bank of America, Poppy Popcorn, some of our alumni. $500,000 went in through directly donation that we give to companies as a grant when they come in to our accelerator. So you first stay in the accelerator, you get a $25,000 grant, you don't repay it. We raised the other $500,000 from high net worth folks, and that's our LLC, the kind of the member structure. So we put companies in a 12-week accelerator based on entrepreneurial competencies. So we tell them, like, we're not going to teach you how to view a balance sheet or put a P&L together. You should be at that point before you get here. Instead, we focus every week on things like opportunity assessment, risk mitigation, building and leveraging networks, tenacity and perseverance, and resilience, and I'm forgetting 9 others. So that's our weekly curriculum, and when they graduate, they get a $25,000 SPA note. So this is a vehicle we've created. It's called the Shared Profit Agreement. The whole thing together with the grant and the SPA note was just the SPA package. Sounds lovely. And I'm gonna get in a little mathy here for you. So companies get $50,000, 25 is a grant, 25 is a SPA note, and then it's a sliding scale of net profit. So bottom line net profit, anything under $120,000, you pay $6,000 on a year. If it gets capped at $180,000, again, net profit. These early companies shouldn't even have that much net profit. So it caps at $9,000. It's a 6-year term. I'll do the math for you. Most of our companies, we expect 18 out of 20 companies in this fund will pay back $36,000 on 50 grand over 6 years. That's a negative 10% interest rate. So donors are happy. They're doing their mission-driven work. Founders are tickled pink. What about the investors? Because their cost of capital is offset by the grants, they're getting a 13% return. It's a MOICA of 1.44x. And it's the kind of companies that grow and stick around and create great jobs because they're tech-enabled businesses. They have knowledge-based work. They have an angle of D2C or e-commerce or some really novel piece of AI to give them just a stronger edge. And we believe this is how we're going to build the future of a resilient community with jobs that want to stay here, and folks who don't need to get follow-on capital and they're not getting chased down by their VCs for an exit.
Perfect. Yeah, I'm still stuck on the SPA note. That sounds fun. Yeah, safe SPA
Trademark.
note. All right, we can go down to Jim. Last but not least, and I think that Jim sometimes gets picked on because there's no more fierce advocate for an ecosystem than our guy Jim.
Absolutely.
So Jim, I'd like for, obviously, so focusing in on the Wilmington ecosystem in particular, I've spent some time down there with you. Can you tell us, you and I talk a lot about the opportunities, the challenges, maybe share a few minutes of how you view that lens and kind of the function of New and WALE and what part they're playing with getting some of this capital to businesses in your area.
So I'll use the B word, begging. No, I figured out even before I moved to Wilmington that I've always had my events on Thursday nights because that is actually the easiest night for parents to get babysitters. So parents can come to our events as entrepreneurs. The other thing is actually a little more conniving, if you will, is that most investors have the other word, beach houses. And so if I invite an investor on a late Thursday, that means they get to spend the weekend at their beach house. That normally the spouse who is not working gets to enjoy a lot more than the spouse that is the entrepreneur. So we've now invited, I want to say 155 investors over the last 10 years to Wilmington, and I've only been turned down once. That's a pretty good record. I'll take that, right? So I invite them to speak, and you know, they have a cold adult beverage. We take them out to dinner. They have a few more beverages, and they talk to the entrepreneurs and kind of spill the secrets. And then the next day, I hope it rains, so they won't have anything to do at the beach, and they'll call the entrepreneur that they met over dinner and talk a little more business, right? So that's really the thing that I label that called the coastal corridor, because I'm inviting people from the Triangle, the investors from the Triangle, the brilliant tech execs from the Triangle to come to Wilmington, and I have something for them to do. I have a great audience. We have the largest attendance in the whole state of North Carolina for monthly startup events at the beach. What city is that? Wilmington. What was the first city that Gritbeat expanded to outside of the Triangle? Yes, Wilmington, thank you. What's the number 7 city in America for job growth and salary growth in the United States? Thank you. We've got it going on. So come to our event this Thursday, because I have the best event. I have the best event in the globe on Global Entrepreneurship Week this Thursday, where I have 4 investors. All 4 of our speakers are investors. I've got the leader of the Angel Capital Association. He lives here, by the way. The leader of the Angel Capital Association lives here in Raleigh. He's coming to my event. Neil Bakchi is an investor in 2 funds. He's a lawyer. Shep Moyle, who teaches at Duke, he is an investor. And then we have Juan Carlos Pacheco from Idea Fund Partners, who just invested in Wilmington for the first time in the history of that fund, invested in a company that my WALE investor network created, invested in, called Skillmaker. And they just raised $2.5 million, which was $1 million over their goal of raising money for. And that had really, in my experience in 10 years, had never happened in Wilmington, to be oversubscribed when it wasn't part of a bank piece of software like Encino or a new company called Simply. So we've got it going on. We invite all of you to our event on Thursday. We got plenty of room. We also have plenty of beer. So come on and make it a weekend at the beach. Thank you.
All right, thanks so much. So I have tons of questions I could ask. However, I promised we'd save some time. We've got just a few minutes left. So do want to turn it over for you guys to take a few minutes to ask some questions to this group, recognizing this is a really great, diverse group of panelists with a lot of experience to share. So we'll do a few minutes of that before we close out.
Bueller?
You guys have been in the ecosystem a long time. You've seen a lot of change, and it's much easier to drive when you're looking in the rearview mirror. So what would you do differently to make your fund or to make your ecosystem grow faster in hindsight, for maybe for some of the regions that don't have a fund like yourself?
Just thinking. I'll give you a second. The so I've been at this 30 years. In the first 20 years, we had a lack of entrepreneurs, and then somewhere around 2013 to 2015, it just kind of changed very quickly. I was super busy, so I wasn't like finger on the pulse. But as I would check in, suddenly we had like this new energy, and what I think happened is the co-working facilities played a big role in it. So what's now called Raleigh Founded, it's been through like 6 names, and then American Underground was a big part of that. And I didn't really put that together before it happened because I was like, there's a million of these co-working things. There's like a trillion WeWorks and Regis's. But then you go to a Regis and it's like this soulless. Is anyone here from Regis? Okay. Yeah, okay. It's like this soulless corporate environment. And like, you know, they put a meter on the coffee in the bathroom and stuff. And yeah. And like, you know, there is this kind of community that kind of like started to just like really accelerate inside of the co-working facilities that I kind of wish I could go back in time and start those in like 2005 because I didn't put that together as an entrepreneur. But also I think something culturally changed. And I talked to a lot of the kids in college, and they all watch Shark Tank, and it's kind of a cheesy show, and a lot of investors laugh at it because it's ridiculous. But it is a bunch of entrepreneurs getting up and doing pitches, and when you're in the audience, you're like, you know, I say it to my daughter, I was like, would you invest in that? And then she's like, you know, they have to think through the math and like understand the percentage and all that stuff, which is really helpful. So I think that culturally was a big change. And then a lot of entrepreneurs in that cohort talk about the Social Networking movie, you know, where Mark Zuckerberg, you know, it's kind of a very, very fictionalized version of the Mark Zuckerberg story where this could be the nonfiction, the actual true part, but you know, he did it to meet chicks and all that stuff. But you know, those things, like there was these cultural things that happened that suddenly made it okay to do it. I don't know what that was, but the co-working I can definitely put my finger on that was like a really big thing that we should have done way earlier.
Yeah, so the reason I hesitated is because we couldn't have created Optimist Ventures without the hurricane. You know, like we had the grant already to build a fund, and it would have been a very typical GP-LP structure. And it was right after the storm. I was talking to Ginger Frank from Poppy in Charlotte while I was walking around the house. And she was like, I really want to start a fund. And I was like, cool, Matt and I are starting a fund. Let's do it. She was like, no, but I don't want to invest. I want to do grants. And so her push to figure out, you know, that we could create a hybrid venture philanthropy fund came completely from Ginger and trying to make the math work. So I'll paraphrase Mayor Williams from yesterday, who said, entrepreneurs eat crisis for breakfast. And the other quote, you know, never let a good crisis go to waste. So I kind of wish we could have gotten here without a crisis, if I could do things differently. There's been a lot of pain and a lot of death and a lot of destruction. But I think kind of the magic of entrepreneurship is the magic words are what if. You know, so what if we combine grants and investments together for an attractive package, and focusing not on what is but what can be. And we've, you know, really visioned what a future of an ecosystem could look like, and it's because of where we came from.
Real quick, the great comments on the past. If you had an opportunity to go ahead and look forward, what major initiative would you actually do or call on the state to do so that we position North Carolina for greatness in the years to come?
That's a great question, Emma. It was actually one of mine if I had gotten to it.
I got a real quick one. Small business incentives for ESOPs and EO trust conversions. Like Tom was talking about yesterday, for every dollar going to a large company's incentive, a portion could go to a pool to support more business ownership, because that's really where you get wealth generation and transfer from.
Please keep NC Innovation. That's my big note. Please keep NC Innovation.
I don't have time to do politics, but all the people that understand politics can solve this one. I meet all these fancy VCs that fly into the Triangle from Silicon Valley, and when I was in my 20s and 30s, I was naive and thought they were coming to visit the startups. They were just meeting with the startups as a way to like wait until they could go meet with the Treasury, the UNC endowment, the DUMAC or whatever it's called, and those people. Then they would all become LPs in Sequoia, A16Z stuff, and take our money to California and invest it and not invest in our startups. So I wish there was a way. Evidently this was a thing, and they lost money because Southeast Interactive put all their money in BuildNet and it went kaput. But there's this whole legacy of why that didn't work one time. But I think it's like apples and oranges, and we got to revisit that at some point. It doesn't have to be much. These things are, these are like $500 billion entities. All it has to be is like 1%. That's all we need. Just keep 1% in the state. And then Jim will get you up to 5 pretty quick. Jim and I'll tag team this thing. I'll get him started. Then I'm going to parachute Jim in there.
I like that. All right, let's go.
All All right, guys, so I think we are at time. A big thank you to our 4 awesome panelists and also to NC Idea. Thanks for letting us wind it down.
That was easy.